In this free video course, you will learn everything you need to know about day trading, whether you're trading stocks, crypto, forex, or any other financial market. By the end of this course, you will not only be able to start day trading, but you will also learn about multiple day trading techniques that most traders don't know about. Alright guys, so let's begin this video by taking a look at what you can expect to learn from this course. And in chapter 1, we will do an introduction to day trading. This chapter will be the foundation for the rest of the course, and during this chapter we will talk about things such as what is day trading, but also of course how do day traders make money, and so on and so on. After chapter 1, we are ready to take a look at the best markets to trade. And some of the markets we will cover here is crypto or cryptocurrency. We will cover stocks as well as forex. In chapter 3, we are ready to take a look at the best day trading platforms. Because in order to day trade, you basically need two things. First of all, you need a platform where you do your analysis, but you also need a platform where you take your trades. So in chapter 3, we will take a look at both analysis platforms, but also platforms where you can buy and sell, for example, crypto, stocks, and forex. Now then, in chapter 4, we are finally ready to start taking a look at some trading techniques. And the very first technique that every single day trader needs to learn about is Japanese candlestick charting techniques. In chapter 4, you will learn everything. You will learn all the basics you need to know about Japanese candlesticks. Next up, in chapter 5, we are ready to talk about some fundamental technical analysis techniques. And technical analysis here is by far the most common method when it comes to day trading. So we are actually going to dive pretty deep into technical analysis. You will learn about some very key concepts. You will learn about some of my favorite technical analysis indicators and much more. So chapter 5 is very important. Last but not least here, and this chapter is super important, in chapter 6, we're going to take a look at market structure and price action, two of the most important things when it comes to day trading and when it comes to technical analysis in general. Just one quick thing I do want to mention before we jump into the course here is that I highly recommend that you watch these chapters in order. So start with chapter 1 here and then go to chapter 2 and then chapter 3 and so on and so on, because each chapter here will build upon the previous chapter. So I highly recommend to watch the chapters in order, but if you want to skip around, you can do that. I will make sure to have chapters on the video so you can jump around to whatever chapter you want. But now guys, let's get this course started. Alright, so first of all, what is day trading? Well, the definition for day trading is pretty straightforward. Day trading is basically when you buy and sell something within the same day. So this something could be, for example, stocks, but it could also be cryptocurrencies or forex. The important thing about day trading is not what you trade. The important thing is that you buy and sell within the same day. And the time here between buying and selling could be as short as just a few minutes. So you can, for example, buy and sell, in only 5 minutes, but it could also be a few hours, right? As long as you buy and sell during the day and don't wait overnight, you are day trading. But now then, what is the goal of day traders? Well, the goal is pretty simple here. The goal is to profit, or in other words, make money from short-term price movements. And what can we trade as day traders? Well, we have already been talking a bit about this, but you can day trade multiple different assets, including stocks, crypto, forex, but also commodities, options, and more. So as a day trader, you have so many options on markets to trade, and that's one thing I really like about day trading. But now, what about some key characteristics when it comes to day trading? Well, the first characteristic I want to talk about is time commitment, because when it comes to day trading, it actually requires lots of time and effort. Because since you are buying and selling within the same day, this means that you have to spend lots of time in front of the charts. So you will spend time looking at charts, but you will also need to spend quite a bit of time learning. Because just like, playing football or cooking, day trading is a skill that takes lots of time to learn. So if you want to day trade, you need to be able to put in hours both learning and trading. But since you are watching this video, that's already a proof that you are willing to commit the time to learn. So that is a very good sign. Another key characteristic that I pretty much already mentioned here is knowledge, but also discipline. So to become a successful day trading, you need not lots of knowledge, but you also need lots of discipline. Because in order to follow your trading plan and not being overwhelmed by all the emotions that comes with trading. When you trade, you will get lots of fear, but also greed. And to not be overwhelmed and act on your emotion, it's important to have discipline. And what about the tools and techniques here? Well, day traders mainly use technical analysis. And during this course, you will learn a lot about technical analysis. But some traders also use something called fundamental analysis. And this could be looking at things like news and financial reports to analyze, for example, stocks, but you can also use fundamental analysis for, crypto and other assets as well. But this course will be mainly focused here on technical analysis because that is by far the most common trading technique. But alright, so now let's take a look at how day traders make money. And two very important things you need to learn about is something called going long, as you can see here, long, and going short. So let's begin here by taking a look at what going long and going short is. So first of all, what is going long? Well, going long is the most common way for day traders to make money. And this is basically when you buy low and sell high. So let's just say that this right here is a stock chart. It goes up like this. When you go long, you basically want to buy low. So let's say that you buy right here. And then you want to catch a short-term move and sell high. So let's say that you bought down here for 100. Let's say that this right here was $100. And maybe you sold here at $110. So you sold up here for 110. Then you would make $10 here. Or to be honest, you would actually make a little bit less because when you trade, you will have to pay a small fee. But maybe you would make, let's say $9 or $9.50. So going long is pretty straightforward, but the opposite of going long is going short. And what is going short? Well, to go short or to simply short, as I said, is the opposite of going long. And this is when you make money from the price going down. So once again, let's say that we have a stock chart right here. And in this case, we have a market where the price goes down. This is what we call a bear market. But what you do when you go short, I will not go into detail here, but what you do is you do something called short selling. And this is actually when you sell a stock without owning the stock. You basically borrow crypto or stocks, you sell it right away. And then you wait for the price going down, and then you do something called buy back. And let's say that this stock went from 110 to down to 100 here. Then you would once again make $10. So this right here is one thing that is so nice about day trading. You can make money when the price goes up, but you can also make money when the price goes down. And another important thing I want to talk about is something called leverage. And what is leverage? Well, day traders can increase both the reward but also the risk by using something called leverage. And in very simple terms, leverage is a tool that multiplies both the gains and losses. So remember the example where we gained $10. If we use leverage, let's say that we use a 2x leverage. That means that for every dollar we win, we now win $2 instead. And for every dollar we lose, we now lose $2 instead. So if we use a 2x leverage, this $10 will be $20 instead. And of course, we can use even higher leverage. So if we, for example, use a 10x leverage, we would have made $100 and so on and so on. And later on in this video, when I talk about day trading platforms, we will talk about, how much leverage you can use when you trade and so on and so on. But one thing I want to point out right away is that, in general, if you are a beginner, using leverage is very risky because yes, the reward goes up, but also the losses goes up as well. So make sure to have that in mind. And this is why I have the last point right here. To make money on a consistent basis, it's important to have good risk management. So you can't just go into day trading and use, 10x leverage and think everything's gonna go to the moon. That is a recipe for disaster. You need to be able to manage your risk. All right, so before we continue here, I want to give a big shout out to all our new channel members. You guys are making these videos possible. I spend a lot of time and effort on these videos, so if you want to give back while at the same time getting access to exclusive content, please consider becoming a channel member by clicking join below this video or on the channel page. Now let's jump back into the course. But alright guys, so now let's take a look at the best markets to trade. And for this, I have a pretty comprehensive comparison here between some of the most common markets to trade. And that is stocks, cryptocurrency, and Forex. So which of these markets are the best? Can we really say that we have a clear winner? Well, let's take a look here. The first aspect we're going to take a look at is something called liquidity. And in simple terms, liquidity is basically how easy it is to trade something or how easy it is to buy and sell something. So for example, if we take a look at a large stock like Apple or Nvidia, that is a stock with very high liquidity because there will always be buyers and sellers ready. So if you have Nvidia stocks, you can sell it in 1 second to a buyer. However, if you want an example of something with low liquidity, you can think about your house. Because in order to sell your house, it usually takes, it can take weeks, it can take months, because there are not, thousands of people ready to buy your house at all times. So your house is hard to buy and sell, while for example, Bitcoin or Apple is very easy to buy and sell. So that is what liquidity means. So what about liquidity for stocks? Well, for stocks, especially for large stocks, liquidity is very good. But if you take a look at very small stocks like penny stocks, the liquidity is usually much worse. And the same is true for cryptocurrency. For very big cryptos like Bitcoin and Ethereum, the liquidity is good. But for smaller altcoin, the liquidity is not as good. When it comes for Forex, it's pretty simple. It's pretty similar. But for the big Forex pairs like, USD Euro, the liquidity is great. Now, the next factor we need to consider is volatility. And you can think about volatility as how stable is the stock or crypto or whatever. So when something just moves a little bit up and down, maybe it moves like 1% a day or something like that, we say that we have low volatility. But if you have something that moves up and down quickly and sharply a lot, that is high volatility. So for stocks, I would say that the volatility here is moderate or medium. Some stocks are much higher volatility, for example, Nvidia, while some stocks are lower. So that's one thing that is really nice about stocks. Depending on what stocks you trade, you can basically choose your volatility. However, for cryptocurrency, I would say that the volatility is very high. It's a little bit lower for the big ones like Bitcoin and so on, but in general, we have very high volatility. And very high volatility also means that it can be harder to trade, especially as, you know, beginners. So if you are a complete beginner, it might be smarter here to choose stocks to begin with because of the high volatility for cryptocurrencies. And last but not least, what about the volatility for Forex? Well, I would say in general, at least for the big pairs, we have sort of medium volatility, but for smaller pairs, it can definitely be high. Another important factor to consider here is the trading hours. And as for the stock market is usually only open on local hours. So for example, here in Sweden, the Swedish stock market is open from 9 to 5 around these times, but that is local Swedish time. So if I want to trade the US stock market, I need to look at the local time for the US and so on and so on. And stocks are also closed on weekends. So this right here is actually sort of one downside about trading stocks. One of the biggest advantages of cryptocurrency is that the crypto market is open 24/7. It's never closed. That's a very good thing about crypto. Forex here is a sort of medium when it comes to trading hours, because Forex is open 24/5. So it's open 24 hours a day, but it's closed on weekends. So it's open 5 days a week. And here, what about the leverage? Well, I can't really say a lot here because this will vary between the brokers. We will talk about brokers later on in this course. But depending on broker, you know, for stocks, it's usually a bit more limited, but many brokers have high leverage for stocks. And when it comes to cryptocurrencies, the leverage can actually go super high. I know that some crypto exchanges have leverage up to 100x. That's crazy high leverage. I would not recommend it actually, but they have very high leverage. Many Forex platforms also have very high leverage. And last but not least, we have 3 more factors. We have transaction costs, we have accessibility and regulation. But to not make this part too long, you can feel free to pause the video here and, you know, read the rest yourself so you can get a better view of the different markets and make your choice about what market is the best market for you. Alright guys, so now let's take a look at the best day trading platforms. And the very first platform I do want to talk about is TradingView. And here, it doesn't matter if you trade crypto, if you trade Forex, stocks, or whatever you are trading. In my personal opinion, TradingView is the best charting platform, or in other words, the best analysis platform, no matter what asset type you are trading. And during the rest of the course, I will be using TradingView to show indicators and other trading concepts as well. So if you want to be able to follow along during the rest of this course, I highly recommend that you at least sign up for TradingView. And to sign up for TradingView, I actually have a special link. The link can be found in the top of the description and in the pinned comment. And you can use this link to receive $15 and try TradingView Premium for 30 days for free. So yeah guys, make sure to sign up so you can follow along for the rest of this course, and don't miss to claim your bonus. The next platform I want to talk about is Binance. And Binance is a crypto exchange. And to be more precise, if I'm not wrong, Binance is actually the biggest crypto exchange in the world. And there are tons of other good benefits about the platform. One thing is that Binance has hundreds of cryptocurrencies that you can choose between to trade. And another big bonus here is that Binance has low trading fees. And as a day trader, it's very important to have as low trading fees as possible because you take many trades. So if we have high fees, the fees will actually add up to a lot over time. So it is very important to have low trading fees. And another thing that's really nice about Binance is that I have managed to get a special link where you can get an additional 10% off on your Binance fees. You can find the link in the description of this video as well as the top comment. The next platform I want to mention here is Bybit. And Bybit is yet another crypto exchange. And one good thing about Bybit is that Bybit also have pretty low trading fees. So that's very nice. And when it comes to leverage here, we have up to 100x leverage on Bybit. So as I said earlier when I talked about leverage, using this high leverage is highly risky, but it can also lead to very high reward. But as a beginner, I would definitely not recommend to use 100x. You know, even 10x is actually pretty high. And I also forgot to mention this, but Binance also have up to very high leverage on futures. But as I said, you can use up to 100x for Bybit. But when it comes to Bybit, I have actually managed to get an insane bonus. To find the link, you want to head down to the description of this video and press on this link right here. And as you can see, by using this link, you can get up to $30,000 in welcome rewards. However, in order to get the $30,000, you will need to trade a lot. So most people will definitely not get $30,000. However, as you can see here, over 80% of users will actually get $100. So that's, you know, much better than nothing. So in order to claim the bonus here, what you want to do here is that you want to make sure to sign up. You also want to make sure that this code right here, 88512, is selected when you sign up. And you also need to deposit money into Bybit, and you also need to trade. You can click right here to check out the full rewards. So if you want to, you can pause the video right here and read about the how to get the rewards here. All right, so the next trading platform I want to talk about is a platform called Interactive Brokers. And this platform is more focused on stocks. So as you can see, you can trade stocks, forex, options, futures, and so on and so on. As you can see here, if we take a look at the leverage, you can see that it has much lower leverage compared to, for example, you know, Bybit, which has 100x, Binance, which has 125x. But that is actually pretty common for stock trading platforms. In general, stock trading platforms tend to have lower leverage here. And when it comes to fees, Interactive Brokers have low fees, so that's great. And it's also available in many countries. I think more than 200 countries. So if you are gonna focus on stocks, you can definitely consider Interactive Brokers. Last but not least, I also wanna mention Wanda here. This platform is more focused on Forex. So I would say Wanda, you can use for Forex, Interactive Brokers for stocks. When it comes to leverage here on Wanda, we have up to 50x leverage. You can see 50 to 1 here is the same thing as 50x. It's just another way of you know, typing it. It has some good fees here, and as you can see, it's a forex focused broker. The downside with Interactive Brokers and Wanda is that I have not managed to get any special bonuses for these two platforms. But as I said, if you want to claim bonuses, you can look at Bybit. If you want to have very low fees, you can look at Binance. And no matter what other platform you're using, definitely guys, you have to use TradingView here. Alright guys, so now we are finally ready to take a look at how to day trade. And right now I am in TradingView. If you guys want a TradingView tutorial, I actually have a full 1 hour long course here on the channel, and I will make sure to link the video somewhere up in the corner here. But right now we are in TradingView and we are currently looking at the Tesla chart right here. But let's say we want to go over here to the Nvidia chart, or perhaps we want to look at Bitcoin. You can see that all of these charts are looking different. But one common aspect about all of these charts is that they are candlestick charts. You can see that every single bar here on the chart is known as a candlestick. And this is by far the most common chart type for day traders. So now, before we can take a look at candlestick charts and, you know, make our analysis to know when to buy and sell, before we can put all the candles together, we need to actually know how to read and how to understand individual candlesticks. So let's do this now. Alright, so now let's take a look at how to read candlestick charts. And the very first thing we need to know here is that we have two types of candles. First of all, we have a red candle, which is also called a bearish candle, and we also have a green candle, also known as a bullish candle. And a red candle basically means that during the candle, the price was going down. And a green candle basically means that during the candle, the price was going up. But now you might of course wonder, how long is a candle? Well, a candlestick can be, for example, 1 day, but it can also be, 1 hour, or even as low as 1 minute. As day traders, we usually use 1 minute, 5 minutes, or maybe 15-minute candles. But you can basically decide how long each candlestick will be. So for example, now we're back here in TradingView, and on this chart, every single candlestick here represents 1 day. And to change the length of the candles, or in other words, to change the time frame, what we basically do is that we go up here to the upper left corner, we press on this button right here, and here you can see that we have multiple different time frames. So if you, for example, go down here and press on 15 minutes, now every candlestick on this chart will represent 15 minutes. But now the candlesticks consist of a few different parts. First of all, we have the body here. And the body is basically the wide parts of the candles. So this part of the red candle and this part of the green candle is known as the body. We also have the wicks or the shadows, and these are basically the small lines here that are above or below the candles. But to actually read and understand the candles, we need to understand 4 more things. We need to understand the open, the high, the close, and the low. And the open here is basically where the candle starts. So for this red candle, the price started right here. We can, for example, imagine that this is a 15-minute candle. So let's say that the time right here is 13 or 1 p.m. So the price started right here. And the close here is the price level where the candle closed. So let's say, as I said, that this is a 15-minute candle. This means that on 13:15, the price was all the way down here. The high right here is the highest point the price reached during these 15 minutes. So the price reached all the way up here as the highest point during these 15 minutes, and the low here is the lowest point the price reached during this time. And the same thing is true, but the opposite for the bullish candle. So remember, for the bullish candle, the price goes up during the candle. So in this case, the price started right here. It reached a lowest point all the way down here. During the 15 minutes, it reached a highest point all the way up here. And when the 15 minutes was over, the price was right here. So let me actually hide my cam here so you can visualize the price movement. So for example, this green candle might have moved something like this. Right here, the candle opened, then it went down to a lowest point all the way down here. During the candle, it went up all the way up here, right? And before the close, the price was right here. So this right here is how the price might have moved. Alright guys, so now we are finally ready to take a look at a concept called candlestick patterns. And as you can see right here on this image, we have tons of different variations of candlestick patterns. But first of all, before we can talk about why these patterns and why they are so important, first of all, we need to of course know what is a candlestick pattern here in the first place. So what is the definition here for a candlestick pattern? Well, candlestick patterns are specific formations created by one or more candlesticks on a chart that gives hints about where the price is likely to go next. And here we have multiple different types of patterns. The first type we have right here are bullish patterns. And a bullish pattern basically signals a potential move to the upside. Then we also have bearish patterns. And this is of course the opposite. The bearish patterns signals a potential move to the downside. But patterns can also be either reversal patterns, which means that they indicate a potential trend change, or they can be something called continuation patterns. And pretty much all candlestick patterns will have one of these and one of these. So for example, a pattern can be a bullish reversal pattern, or perhaps a bearish continuation pattern, or a bearish reversal pattern, and so on and so on. So let's say that this right here is the price, and this circle right here represents a bullish reversal candlestick pattern. What does this mean? Well, remember, bullish means that it signals a move to the upside, and reversal indicates that the trend will change. And in this case, the trend before the pattern was a downtrend. So a bullish reversal pattern must indicate a reversal here to the upside. And as I mentioned earlier, right here on the screen, we have tons of different candlestick patterns. But what I'm gonna do next is that I'm gonna show you guys some of my personal favorite candlestick patterns and how to trade them. All right, so now the very first candlestick pattern I want to show you guys is called the hammer pattern. This pattern right here is known as a simple pattern. And a simple pattern is a candlestick pattern that consists of only one candle. And in this case, the actual pattern is this one right here. The direction of this candlestick pattern is bullish, and the type of the pattern is reversal. So before the pattern appears, we need to see a downtrend. Then we see the actual pattern, and the goal of the pattern is to reverse the price towards the upside. To identify the bullish hammer pattern, we need to look out for two things. The first thing we want to look out for is that we want the body, or in other words, the wide part of the candle, to be pretty small. And at the same time, we also want to see a long lower wick. This lower wick needs to be at least twice the size compared to the real body. But preferably what I want to see is that I want to see a wick that is, maybe 3 times or even 4 times as large. As you can see in this particular case, the wick right here is maybe 3 to 4 times as large compared to the real body of the candle. One last thing you want to look out for when it comes to the hammer pattern is that the upper wick here should either be, very small or not existing at all. So the smaller the upper wick, the better. All right then, so now when you know how to identify the hammer, now let's take a look at the hammer pattern trading strategy. So how do we actually trade this candlestick pattern? Well, the first thing we need to do is of course to find the patterns. So here, if you want to, you can try to find the hammers on your own. So if you want to, pause the video right now and try to find the patterns. Did you find any hammer patterns? Well, let's take a look here together. So first of all, right here, you can see that we had a very strong move towards the downside. And then we saw this green candle right here appear. And what you can notice here is that this lower wick of this candle is indeed more than twice the size compared to the real body here of this candle. So one could definitely see this right here as a hammer. However, I actually see some better hammers on this image. The best hammer I can find is actually this hammer right here. As you can see, in this case, we have a very long lower wick and we have a tiny real body of the candle. Another thing that makes this pattern even more significant is look at where this pattern appears. Well, as you can see, the price, bounced right here, and then we saw another bounce. So as we can see, this hammer pattern is actually coming in at a key support level. And by the way, guys, we will talk more about the concept of support and resistance later on in this course. But for now, we can just notice that this hammer is actually appearing at a support level. And another thing we can notice is that the price actually quickly dipped below support and then pushed above. And this right here is something I personally really like to see. But all right, so now we found a great hammer. But now you might of course wonder, you know, when do I buy, when do I sell, and where do I place my target? Well, the most common way to enter the hammer is to enter the hammer here at the close of the candle. So remember, since this is a red candle right here, the candle closed right there. And I also actually forgot to mention that, as you can see, this candle right here is red. And hammers can be either red or green. It doesn't really matter. The most important thing is that we have a long lower wick and a small real body. But as you can see, the most common entry point is right here. So the green line is the entry. And as for your stop loss, this can differ a bit depending on the market structure. And we will talk more about market structure later on in this video. But as a rule of thumb, we usually want to place the stop below the extreme of the pattern. So we want to set the stop loss here. So this right here is our stop level. We usually want to set the stop below the lowest point of the hammer. And what I usually do is that I usually leave a little bit of wiggle room as well. And now, last but not least, where do we place our target level? Well, as for the target, we have a few different methods. One method is to look at previous market structure. So for example, right here, we might have some sort of resistance. So some traders might argue that we can place the target just below this resistance. Another much more simple method to find your target level is to use a fixed risk to reward ratio. And in simple terms, the risk to reward ratio is basically when you measure the length between your entry and your stop. So for example, a 1-to-1 risk to reward is when we have the target as far from the entry as our stop loss. So this right here is a 1-to-1 risk to reward. Almost more common risk to reward is to set your target at a 2-to-1. That is basically when the distance up to the target is twice the distance compared to down to the stop. So if we use a 2-to-1 risk to reward for this trade right here, then our target level would be right here. And as you can see, it took a few candles here, but our target level got reached pretty quickly. The next candlestick I want to show you guys is called the bullish momentum pattern. And this pattern right here is one of my personal, favorite candlestick patterns. So make sure, guys, to really pay attention now. But first of all, what about the complexity? Well, I would actually say that the momentum pattern is a simple candlestick pattern. So it only consists of one candlestick. But it's actually a little bit more complicated, because in order for this pattern to be valid, we actually need to look at the previous candles as well. And I will talk all about that soon. But the complexity, I would say, is simple. One could argue is complex, but the direction here is bullish. So it indicates a move towards the upside, and the type here is continuation, which means that before the pattern, we want to see a move towards the upside. And since this is a bullish continuation pattern, the goal of this pattern is to continue the trend towards the upside. But now then, how do we identify the pattern? Well, the main thing we're looking out for here is that we want to find a candle with a very long real body. Or to be more specific, I want this candle to be at least twice the size compared to the real bodies of the 3 candles that comes before the actual momentum candle. And preferably, I want this, bullish momentum pattern to be maybe 3 times or even 4 times as large as, the previous candles. So what we essentially are looking out for here is that we want a very strong candle relative to the previous candles. Alright, so let me just show you guys a quick example right here. As you can see, if you look at this candle right here, you can indeed see that the real body of this candle, so from this point to this point, is much more than twice the size compared to all of the previous candles right here. So this right here was indeed a momentum candle. And after this candle appeared, you can see that we got very nice follow through. We saw a massive move here towards the upside. And let's zoom out a little bit more. Here you can see another very clear example. If you take a look at this red candle right here. Once again, you can see that the real body, so from this point, remember this is the open, this is the close, the real body of this candle is much larger compared to this whole range right here. So this right here was a clear momentum candle towards the downside, and we can see that this candle was the sort of the beginning here of a sort of downwards looking trend, right? So momentum candles can be really powerful, but they are best used together with other concepts, like for example, market structure. And we will talk more about that later on in this course. But alright, so last but definitely not least, I want to show you guys the bull flag pattern. And this right here is a very large candlestick pattern. So as you can see, this is definitely a complex pattern. A complex candlestick pattern is just a candlestick pattern that consists of more than one candlestick. And the two previous patterns we talked about was just simple patterns, but this one is definitely complex. The direction here for this pattern is bullish and the type is continuation. So before the bull flag, we want to see an uptrend. Then right here, the actual pattern appears, and after the bull flag, the goal is to continue the price towards the upside. But now then, how do we identify the bull flag? Well, as I said, before the flag appears, we want to see a strong move towards the upside. But then after this strong move, we actually start to see a move in the opposite direction. These candles will often be small, like for example right here, you can see a small red candle, and they will often be red here. These candles doesn't have to be red. The most important part is that we have small candles that goes, slightly in the opposite direction of the previous move. The last candle here that is very important is this green candle. And what I like to see here is that I want the green candle to close far above the whole red candle right here. It can be possible, if we have a wick, if the red candle looks something like this and have a wick above, that's fine. But preferably I want this green candle to close above. So the entry point is often at the candle close of this pattern. So right here would be our, entry. And you might of course wonder, where is a good place to set your stop loss? Well, as always, it will differ a bit depending on the overall market structure, but a rule of thumb is to set the stop loss here below the extreme low point of the pattern. And I also, as you guys know by now, I like to leave some wiggle room here. Let me just show you guys. So as you can see, the lowest part of the pattern was right here. So I like to set the stop loss quite a bit below that point, right? And as for your target, you can either use, as we talked about earlier, a fixed risk to reward. So you measure the distance from the stop to the entry, and then you take this distance, and if you are using a 2-to-1 risk to reward ratio, then your target would be somewhere up here. But yeah, candlestick patterns can be a very useful tool, but as with many technical analysis concepts, they can become much stronger if you combine them with other technical variables like market structure and other price action concepts. So make sure to watch the rest of the course and really pay attention. But alright guys, so now we are back in TradingView here, because now I want to show you guys an auto candlestick pattern indicator. But if I remember correctly, in order to be able to use this indicator, you need a paid TradingView plan. But remember guys, by using the link here that will be both in the top comment as well as the top of the description, you can try out TradingView Premium for free for 30 days, and at the same time you will get a $15 bonus if you eventually decide to upgrade. But now then, so to open up the indicator, what you want to do is that you want to go up here to the indicators tab in TradingView. And then you want to search for all candlestick patterns, just like this. And by the way, if the pattern doesn't come up when you search for it like this, you can try to add a star here in the beginning. I've had some comments earlier that had a hard time finding this pattern, so you can try to add a star or even search for this in your own language. But the indicator we want to open is this one right here, all candlestick patterns. Next, we want to navigate up here to the upper left corner, and we want to press on the settings button right here. And now, as you can see, when you scroll down, you can see that we have tons and tons of different candlestick patterns that you can choose here. And all the patterns you choose, the indicator will automatically identify. So this right here is indeed an amazing indicator. I really like it. But what I do recommend here, and this is the standard setting, I think. So you can see that it detects the trend based on the simple moving average 50. And I actually recommend to keep this one because this is a good way to filter out many of the false signals. So make sure to keep the SMA 50, or at least if you want to. You can also do no detection, but if you do this, you will get many false signals. So I'm going to keep the SMA 50 here. And just to show you guys, let me actually uncheck everything except the hammer pattern we talked about earlier. So if we only choose hammers, now this indicator will automatically identify hammers only. So let's do this and press OK. So as you can see, if we zoom out a bit here, you can see that right here, TradingView identified a hammer. You can see before the hammer, we had a downtrend, and after the pattern, we saw a strong movement towards the upside. So this pattern was quite successful. Let's see if we have any other hammers. You can see it's pretty rare here. It doesn't really happen all the time. But once again, right here, we had another hammer. We saw a strong move towards the downside. Then the price reversed right here. Let's see here. Let's actually change the time frame here to the daily time frame. So now every candlestick represents 1 day. Let me see if we have any hammers. Well, as you can see, we saw a hammer right there. It was a very nice reversal. But let's actually see if we can find any failed hammers, because hammers will not work all the time. So for example, here you can see that we once again had a hammer, but in this case, unfortunately, you can see we had a move towards the downside, then right here the pattern appeared. But if you set your stop loss right here, you would have actually got stopped out with this little wick right here. So you can see hammers doesn't work perfectly all the time, but this, in my opinion, is still a very solid indicator. So guys, I highly recommend to actually get this indicator. Alright, so now it's time to take a look at support and resistance. And this right here is a concept at the very core of day trading and technical analysis. So make sure, guys, to really pay attention to this chapter. But first of all, let's take a look at the definition here of support and resistance. A support level is basically a level where the price is likely to stop falling due to buying pressure. So as you can see on the image right here, the support level is the lower level right here. As you can see, the price stopped falling here 1 time, 2 times, 3 times. And every time we reached the support, we actually saw strong bounces to the upside. And what about resistance level? Well, a resistance level is basically the opposite. A resistance is a level where the price is likely to stop rising due to selling pressure. So on this image, this right here would of course be the resistance. You can see the price stopped falling right here. We saw lots of selling pressure coming in. We saw lots of selling pressure coming in once again right here. But here, and this is very important, I realized that I probably made a mistake, or not really a mistake, but I probably should have said that a resistance is not a level, but it's rather an area. And the same thing is also true with support. It's better to see support and resistance levels as areas compared to straight lines, because in real markets, support and resistance will very seldom be perfect lines on the chart. More often, there will be like broader areas. For example, something like this or something like this. So already at this point in the course, I want you guys to sort of think about support and resistance areas instead of support and resistance levels. But now then, what about the use cases of support and resistance? Why is support and resistance even important when it comes to trading? Well, first of all, we can use support and resistance to try to predict price movements. We can anticipate, for example, potential reversals or continuations based on the support and resistance levels. And what about the trading strategies? Well, one very common trading strategy is the breakout trading strategy. And this is basically when you buy or sell when the price breaks through support or resistance. So for example, right here at this point, you can see that this is the point where the price actually breaks the resistance. And this is actually a common entry level, and many traders specialize on breakout trading. So they only focus to actually buy or sell when a support or resistance level breaks. But we also have another type of traders, and that is reversal traders. And this is basically the opposite of breakout. Reversal trading is buying or selling when support or resistance holds. So for example, buying at this point, so if you would buy right here, this would be what? Well, this would be a reversal trade because the support is holding and your goal is for the price to reverse from down to up. But if you go short at this point right here, this is also a reversal trade because now your goal is for the price to reverse from up to down by the resistance holding. Last but not least, we also have something called range trading. And this is basically traders that focus on trading inside ranges like we, for example, have right here. So range trading, as I said, is trading within a defined range or between, well-defined support and resistance areas. But alright guys, so now we are once again back in TradingView, and now I want to show you guys one of my favorite support and resistance indicators. As you can see, this indicator right here finds the high and low points here in the market, and we can actually use these high and low points to find key support and resistance levels. And let me show you guys how to do this. But first, let me delete that indicator and show you guys how to get this one step by step. So step number one here is to once again go up to the indicators tab in TradingView, and then you want to search for pivot points high, low, just like this. And as you can see here, we have multiple different indicators. These are all indicators created by the TradingView community. But the indicator I want to use is this one right here. This one is created by TradingView called pivot points high, low. So you want to open this one up. But right now you can see that we have, first of all, these points are not really clearly visible. And you can also see that we have many more points than we had before. So now we need to change a few settings. So to do this, we go up here to the upper left corner and we press on the settings tab right here. And the first thing you want to do is that you want to change the pivot high to 20. You want to change the pivot low to 20. And we also want to have, this is basically the length of the pivot points from left and right. So we want to make sure to change 20 here and here as well. And to make the points be more clearly visible, I want to change this one to black, this one to black, this one to white, and this one to white. And now you're ready to press OK. Now, as you can see, we have the points here very clearly visible on the chart. But now then, okay, so now we have the pivot points on the chart. But now you might wonder, how can we use these pivot points to find significant support and resistance levels in the market? Well, what I like to do here, or one method, I'm not saying that this is, the best method to find support and resistance, but one method you can do is that you can contain as many pivot points as possible in an area. These areas tend to be significant. So once, the price breaks this area, like we, for example, did right here, you can see we broke this area, we actually saw a massive move towards the downside. And this area indeed turned out to be significant. Another interesting thing we can notice here is that while we had this support area right here, we also printed, lower highs. So as you can see, and by the way, if we drag this area out even longer, you can see even more significant touches. So this was a really strong support level. But what I want to show you guys here is that here we have one high. We have a lower high, lower high, lower high, lower high, lower high. And here you can start to see that we're actually starting to print a massive chart pattern. We're going to take a look more at chart patterns later on in this course, but this right here is such a perfect example. So let me just show you guys. If we use our trendline tool here in TradingView, you do it by pressing right here, trendline, that here it looks like we pretty much have almost like a perfect triangle. You can see in between the support area and the downward sloping resistance, the price is getting squeezed here in a tighter and tighter range. And you can see that just before the break to the downside, we saw, you know, the range getting super tight. Oops, let me actually delete the drawing. But you can see that just before the breakout here, it got tighter and tighter, and then bam, the price completely collapsed to the downside. And yet another example here, if we look a bit more to the left, you can once again see, if we take a closer look right here, you can see one pivot high, another pivot high right here. And these levels indeed appeared here at a key resistance. You can see these two highs and even the high right here created a key resistance level. And let's take a look at what happened when this resistance broke. Well, once again, you can see that when we broke this level, we saw a massive move here towards the upside. Alright guys, so now we are finally ready to take a look at trend lines and trend channels. These are two very common but also important concepts in day trading. So first of all, let's take a look at the definitions here. A trend line is basically a straight line drawn on a price chart that connects two or more highs or lows. So for example, if you take a look at this image right here, we can see that the price is currently in an uptrend, and right here we have a trend line that connects 1, 2, and even 3 lows here. But now then, what about a trend channel? Well, a trend channel is just a pair of parallel trend lines that highlight the upper and lower boundaries of a trend. So as you can see on this image right here, the important thing about a trend channel is that the lines need to be parallel. So the lower line and the upper line, in the case of an uptrend, need to have the exact same slope. But now, what about the different types of trend channels? Well, first of all, we have the ascending channel. This is a trend channel formed by two parallel upward sloping trend lines. So for example, this trend channel right here is an ascending channel. But we also of course have the descending channel. And this is just the opposite. A descending channel is formed by two parallel downward sloping trend lines. So if we have a trend that goes something like this, then the descending channel would be created by connecting the highs here and the lows. But we actually also have a third type, and that is the horizontal channel, or in other words, the trading range. And a trading range is formed by two horizontal trend lines, which indicates that we are in a range-bound market. So when we have a trading range, we have two lines that goes like this, and the price action is defined within these trend lines. Alright, so now when you know about both support and resistance, and you also know about trend lines and trend channels, now we are finally ready to learn about chart patterns. So first things first, what is a chart pattern? Well, chart patterns are basically specific formations created by price movements on a chart that gives clues about where the price is likely to go next. So for example, if you take a look at this image right here, this right here is a chart pattern we call a bull flag. And this is a specific pattern. When the price goes up, it consolidates for a while, and then the goal of the pattern is to continue the price towards the upside. Here we have yet another chart pattern. This right here is a head and shoulders pattern, and this is a reversal pattern. So the goal of this pattern is to reverse the price from a downtrend here to a movement towards the upside. And later on in this course, we will take a look at some chart patterns and how to trade them step by step. But for now, what I do want to mention here is that chart patterns are, similar to candlestick patterns that we talked about earlier. But the main difference here is that chart patterns are often larger patterns, and they cover longer time periods. So when you trade chart patterns, you are often more focused on larger price movements compared to when we trade candlestick patterns. But you can also, as a trader, combine both candlestick patterns and chart patterns. That's definitely possible, and I will talk more about that later. Okay, but now then, what are the different types of chart patterns? Well, first of all, we have bullish patterns, and bullish patterns basically signals a move towards the upside. And we also, of course, have bearish patterns, which basically signals a move to the downside. But just as with candlestick patterns, chart patterns can also be either reversal patterns, which indicates a potential trend change, right? But they can also be continuation patterns, which indicates that the trend will continue. And once again, just as with the candlestick patterns, chart patterns will either be bullish or bearish, and they will also be either a reversal or continuation. So you will combine one of these factors, or you will have one either bullish or bearish, and you will have either reversal or continuation, and that way you can classify the chart patterns. Or at least this is true in most cases. Some chart patterns, at least in my opinions, don't really have any predictive power, and I actually talk more about that in my full chart pattern trading course. So if you have the time, I highly recommend to check that video out. I will link the video somewhere up in the corner in the eye. But just as an example, if we take a look at this pattern right here, this right here is a bullish chart pattern because it indicates a move towards the upside. And now, would you say that this pattern is a reversal pattern or continuation pattern? Well, since the goal of this pattern is to continue the previous uptrend, this right here is a bullish continuation pattern, right? So now let's take a look at some specific chart patterns and how you can trade them step by step. And the first pattern I want to show you guys is the inverse head and shoulder pattern. And first of all, what direction is the pattern? Well, this right here is a bullish pattern, and the type here is reversal. So before this pattern appears, we have a downtrend, then the sort of red part right here is the actual pattern, and the goal of the pattern, since it is a reversal, is to reverse the price from downtrend to uptrend. But now then, how do we identify the inverse head and shoulders? Well, we need to look out for three things. First of all, we want to see one low right here, which we will have if there are a previous downtrend. So we look out for one low, and then we want to see a lower low, but then we want to see a higher low. So we have low, lower low, and then higher low. And what we then want to do is that we want to connect the points here in between the two highs right here and right here. So we want to sort of draw a line that connects these 2 points. And here it's important to mention that this line will not always be straight. You could imagine that we have a head and shoulders, inverse head and shoulders that look something like this. We have, our first low, then we might have a lower low, and then we might have a low that maybe goes something like this. In this case, how would you draw the pattern? Well, you would draw the line here connecting this high and this high. It would be a downward sloping line. But we could, of course, also have, the pattern looking something like this. We have the first low, then we have a lower low, but then we could have a higher low that looks something like this. And in this case, we would connect the pattern like that. But all right, guys, so now let's take a look at how we can actually trade this pattern. And first of all, I hope you can see that this right here is a head and shoulders pattern. It's much harder to spot in real markets. As you can see, this pattern would actually be, pretty hard to spot in real markets, especially if you are a beginner. But this is just when practice comes in. The more you look at charts, the easier these patterns will be to spot. And later on in this video, I will also show you guys an indicator that can help you guys find these patterns automatically in TradingView. But for now, I want you to notice that we have a low right here, then we have a slightly lower low, and then we have a higher low. So in this case, we do indeed have a head and shoulders pattern, and you can also see that we draw this downward sloping line connecting the highs here, just as I showed you guys. But now you might wonder, how do we enter this pattern? Well, one entry method is to enter at this sort of candle that breaks out. So you can enter at this candle right here. But in this case, this was probably not where I would have entered, because you can see the breakout candle was a black one, or in other words, a red one, indicating some selling pressure here. So another way to enter is to actually wait for the retest. And what I mean by the retest? Well, you can see at this point right here, the price test the previous resistance, right, as support. And you can also see that we got some nice follow through from this retest. So another potential entry point could be at the bounce of this point, so around right here. If you enter at this point, I think the obvious stop loss would be to either place it below this low right here, or even place it below the previous low, because they are almost at the same level. As for your target level, you can either use a fixed risk to reward, so you can measure this with a 2-to-1 risk to reward. The distance up to the take profit is twice as long, so your take profit would be right around here. But another method to take targets when it comes to head and shoulders patterns is to use something called a 100% measured move. A 100% measured move is when you measure the price from the low of the head and shoulders up to the line connecting the highs. So you take this measurement, and then you take this exact measurement from the breakout. So perhaps using this method, our take profit would be around here. Alright guys, so the next pattern I want to show you guys is called the falling wedge pattern. And this is actually a special pattern because, as you can see, this pattern can both be a reversal and continuation at the same time. But either way, in both cases, this right here will be a bullish pattern. So how do we identify this pattern? Well, what you want to look out for is that you look out for the price printing lower highs, and at the same time, we want to see the price printing lower lows. But we need another thing here, and this is important. We need the slope of the line connecting the highs to be a bit steeper compared to the slope connecting the lows. So as you can see, this falling wedge sort of gets tighter and tighter here, and what we are looking out for is a strong breakout from this wedge. But because this wedge can be both a reversal and a continuation, it doesn't matter if we have a downtrend before the pattern, because if we have a downtrend before, it's a reversal with the goal of course, reversing the price towards the upside. But if we have an uptrend before the pattern, then this will simply be a continuation pattern with the goal of continuing the previous uptrend. So now then, let's take a look at an example of how we can trade this pattern. And in this particular case, you can see that before the pattern appears, we have an uptrend. So in this particular case, we're looking out for a continuation falling wedge. So as you can see, we had this nice and strong upwards movement, and then the price started to consolidate here for a while. The price started to go sideways. This is often a good sign when the price cools down after a strong impulsive move. But as you can see here, we are printing lower highs, and we're also printing lower lows here. But the slope of the upper line is steeper compared to the lower line, so that is a good sign. But now then, what about the entry point and stop loss level and so on and so on? In this case, we actually got a solid entry point right here. Why was this a good entry? Well, what we like to see here when we break out from the pattern is that we like to see a strong candlestick. In this case, we can actually see that this was pretty much a momentum candle. So as you guys remember from earlier in the course, we talked about momentum candles. This one is maybe a momentum candle. I'm not sure if this candle is less than half the length of the real body of that candle, and that is what we need in order for this one to be considered a momentum candle, in my opinion. But it's still, a strong breakout. I like to see long real bodies when we break out. But now then, what about the stop loss level? Well, I think the most obvious stop loss is to place the stop loss just below the low of the falling wedge. So you can see the low is right here. So we place our stop loss below that point. And as for your target level, we have two main ways or methods we can take targets. One way is to measure the impulsive move from low to high. You take this exact same length and you measure up here. So in this case, your target level would be around here. But another method you can always use is to measure the length here from stop loss to entry. And then you can use a fixed risk to reward ratio of 1 or 2. It really depends on your trading style. But if we use a 2 to 1, your target would be right around here. Alright, so now I want to show you guys an indicator that can find chart patterns automatically, and they also automatically finds the target levels for these chart patterns. So as you can see right here on the chart, we currently have the indicator on. Right here we have a pattern that is currently in process. You can see we broke out right here. But we can also look back and take a look at how the previous patterns played out. Right here, we have a falling wedge. We can see that before the wedge, we have an uptrend. Then the price started to consolidate, print a tighter and tighter range. Eventually, we broke out here. And as you can see, it took a while, but we reached the target all the way up here. You can also see that at the same time, this indicator identified a double bottom. You can see we had one bottom right here. We had another bottom right here. We connect the high here in between the bottoms, we broke out and we reached the target right there. But now you guys of course want to know how to find and open up this indicator, so let me delete this one right here. So the first thing you need to know about is that this indicator is only available for TradingView Premium. So make sure guys to use the link in the description or the top comment of this video to try out TradingView Premium for free for 30 days and also grab your $15 bonus. But alright, so to open up the indicator, we want to navigate up here to the indicators tab, and then we want to search for all chart patterns right here. And the indicator you want to choose is this one at the top called all chart patterns. Now you want to press on X, but in the beginning, when you first open up the indicator, you can see that only one sort of chart pattern appears. Only the last one will appear here. So to change this, let's go up here to the settings tab right here. And you want to go down where it says patterns. And then if you press this button right here and click on all, now all the chart patterns will be displayed here on the chart. And here you can also choose to display the patterns in progress or not. I would keep this one checked. And what you also can do here is that, if you only want to trade certain patterns, you can choose exactly what patterns you want to be displayed here on your chart. So for example, some chart patterns I really like the bullish and bearish flag. The double top and double bottom are also solid patterns, especially for trading, failure test patterns and so on and so on. So they can definitely be useful. The head and shoulders and inverse head and shoulders I talked about is also, a pretty good pattern. However, these patterns are pretty rare to find good ones, but they can still be useful. So, feel free to mess around with this indicator and, see which of these patterns works best for you. But now when you are done, you want to go down here and press OK. So yeah, I have already pretty much showed how this indicator works, but let's look back a bit more here. So for example, right here, you can notice that we had a falling wedge. In this case, we actually had a sort of downtrend before the pattern. Then the actual pattern appears. We got a tighter and tighter range. We broke out here, and then eventually we reached our target. But alright guys, so now let's take a look at market structure and price action. These two concepts are, I would say it's something you can't do without as a day trader. You really need to understand the market structure and price action. This is basically how the markets move. So let's take a quick look at, market structure and price action and the difference between these two concepts. So first of all, what is market structure? Well, market structure basically refers to the past price movements, represented in the charts. So for example, like support and resistance, trends, chart patterns, and everything like that. All of that is market structure. So you can think about market structure as a map of where the prices have been in the past. But if all of these things are market structure, then what is even price action? Well, price action basically refers to the real-time price movements of the chart. So how is the price moving right now? When you hear terms like, the price is moving aggressively, or we are seeing strong momentum, all of these things are referring to price action. So what is the character of the price movements? So price action is basically dynamic, and it tells a story of what's happening in the moment right now. So if you guys look, for example, at this image right here, the sort of market structure here is, for example, you can see this resistance level right here. This is market structure. So you can think about the actual resistance as market structure, while price action is all about how the price is moving right now. So we take a look at how is the price sort of reacting to the market structure. And in this particular case, you can see something very interesting. You can see that when the price broke above this resistance, you can see this one acted as resistance multiple times. When the price broke above the resistance, we saw a very strong candle. And this is exactly what we're looking out for when we're looking out for price action. How is the price behaving in relation to market structure? And guys, if you want to learn more about market structure and price action, I actually have full courses on both price action and market structure. So I will make sure to link my market structure course right here, and I will also make sure to link my price action course right here. And I do highly recommend to watch both of them. Alright, so this video is coming to an end very soon, but first I want to thank you all so much for watching. I also want to give a big thank you to all our channel members. You guys make these videos possible. To support the channel, consider becoming a member by clicking join, or simply drop a like on the video. And last but not least, when you are ready to continue your trading journey, I highly recommend checking out this playlist. It contains all the educational trading courses I have made so far, and more is coming very soon.